You hear about them constantly, those massive corporate mergers and acquisitions, billion-dollar deals announced, lots of buzz.
Yeah, big fanfare, usually. Company A buying Company B.
Exactly. And they feel huge, maybe a bit removed from, the average investor.
Yeah.
But what if there was a way? What if you could actually find opportunities in the gap? The gap between that announced price and where the stock trades before the deal actually closes.
There is. And that gap, it has a name. It's the arbitrage spread. And there's a whole investment strategy built around capturing it.
Right. So that's what this deep dive is all about. Merger arbitrage. We're going to really unpack this.
We are. We'll look at how this strategy works, how that potential profit, the spread, is actually calculated.
And what influences it, what makes it bigger or smaller, plus the risks. Definitely the risks.
Absolutely. And we'll dig into what our sources say about how it performs, who can access it. Basically, give you a real sense of this corner of the market.
Okay, let's dive in. A different way to look at M&A deals.
So let's start right at the beginning. Merger arbitrage. What is it, really? At its heart, like I said, it's what we call an absolute return strategy.
Meaning its success isn't just tied to the S&P 500 going up.
Exactly. The goal is to make money whether the overall market is bullish or bearish. It focuses on specific events, these announced mergers, takeovers, maybe even big reorganizations.
Okay, so less about forecasting the whole economy, more about predicting if this one specific deal will happen. How does the pricing work? How does the opportunity actually show up?
It really boils down to a kind of temporary difference in pricing. So when Company A announces it wants to buy Company B, they almost always offer a price that's higher than Company B's current stock price.
That makes sense. They have to offer a sweetener, right? A premium to get shareholders to agree to sell.
Precisely. That's the acquisition premium. Now, you'd think Company B's stock would just instantly jump right up to that offer price.
Yeah, seems logical.
And it does jump, usually quite a bit. But, and this is the key bit, it typically doesn't go all the way up. It often trades at a discount to the final offer price.
Ah, okay. So there's still a gap, even after the announcement.
Yes. And that gap, that difference between the price Company B is trading at on the market and the price Company A has offered, that's the arbitrage spread.
The spread. So the basic strategy is what?
Right.
You buy Company B stock at that lower market price, the one with the discount, and you hold it, betting the deal will close successfully. When it does, you get paid the higher original offer price.
That's the fundamental play. Yeah. It's like, think about agreeing to buy something today, knowing you've got someone else already lined up who's promised to pay you more for it tomorrow.
Right.
But the catch is the whole thing depends on that transaction actually going through as planned.
Like that pink lemon analogy we saw. You agreed to buy lemons wholesale in June for $100. But you've already got a contract to sell them in July for $120. You buy low, sell high, pocket the $20 spread.
Perfect analogy. But you have to make sure those lemons get delivered in July.
Right. The deal has to close.
Exactly. So you buy the target stock Company B on the market below the deal value. If it closes, you get that higher value. The difference is your profit. But it's all tied to that specific deal completing on time.
Got it. And you mentioned deals aren't all structured the same way. That must affect how this works.
Oh, absolutely. It makes a big difference. Our sources lay out three main types.
Okay.
First, you've got your cash merger. This one's the most straightforward for arbitrage. The acquirer, Company A, just pays cash for every share of the target, Company B.
Simple enough.
Yeah. You buy Company B stock at the discount, the deal closes, you get the cash amount per share. The spread is just the cash offer minus the current market price. Easy peasy.
Okay, what's next?
Second is a stock-for-stock merger. Now it gets a bit more complicated. Instead of cash, Company B shareholders get shares in Company A.
Ah, okay, so the value isn't fixed.
Exactly. It depends on Company A's stock price when the deal finally closes. They set an exchange ratio like you get, say, 0.5 shares of Company A for every share of Company B you own. But what that 0.5 share is worth depends on Company A's stock price, which is moving around.
So the value of what you get at the end is a moving target. That definitely adds complexity. You're not just betting the deal closes, you're also exposed to the acquirer's stock price.
You are. It requires more analysis, sometimes hedging strategies like shorting the acquirer's stock, which adds another layer. And third, you have mixed consideration mergers.
Best of both worlds. Or worst.
Well, it's a mix. Shareholders get some cash and some stock in the acquiring company. As you'd guess, it combines the features and complexities of both cash and stock deals. Calculating the spread and the risks gets even more involved.
Okay, so buying the discounted target stock is the core idea. But why is there a discount at all? If a deal's announced, isn't it yeah, basically done?
That is the fundamental question here. If a deal was absolutely 100% guaranteed to close tomorrow, perfectly smoothly,
Then the price would match the offer, right? Maybe minus a tiny bit for trading costs.
exactly. The target stock would trade right at the offer price. The reason the discount exists, the reason there's a spread, is uncertainty, risk. There's always some chance, however small sometimes, that the deal won't happen as planned.
It could get delayed.
Delayed, yeah. Or worse, it could just fall apart completely.
Yeah.
Terminated.
The pink lemons never arrive.
That's the risk. And the size of that spread, that discount, it's not random. Our sources break it down. There are components that investors are looking at.
Okay, like what?
Well, first, there's what they call the deal risk premium. This is basically the market demand and compensation for the specific risks tied to this particular deal.
What kind of risks?
Could be anything. Maybe there's a worry about antitrust regulators blocking it. Or maybe the financing looks a bit shaky. Or maybe there's a chance the shareholders won't vote yes. The market tries to price in the odds of these things going wrong.
So if the market thinks a deal has a high chance of failing,
The spread will be wider.
right, the market demands a bigger potential reward to take on that bigger risk. A really wide spread is often a sign the market sees serious potential problems.
Okay, so spread size equals perceived risk. Got it. What else?
Then there's the time to close premium. This is all about the time value of money. Think about it. When you invest in an arbitrage deal, your capital is tied up until that deal closes.
Right, you can't use it for anything else.
Exactly. So the longer the deal is expected to take, the less attractive a fixed dollar spread becomes on an annualized basis. Earning, say, $2 on a deal that closes in 3 months is way better than earning that same $2 on a deal that takes 18 months.
Because you could potentially do multiple short deals in the time it takes for one long one to finish. The annualized return is much higher for the faster deal.
Absolutely. Time is a critical factor. A small-looking spread might actually be quite attractive if the deal is expected to wrap up really quickly, and a big spread might not look so great if it looks like it's going to drag on forever.
Makes sense. Time value of money. Is there a third piece? Yes, the risk-free rate. This is basically the return you could get from a theoretically risk-free investment over the same period. Think short-term U.S. Treasury bills, T-bills.
Why does the T-bill rate matter for a risky merger deal?
Because arbitrageurs are always comparing. They need to earn a return that's better than the risk-free rate to compensate them for taking on all that deal-specific risk we just talked about. The risk-free rate sets the baseline, the floor.
Okay.
So if interest rates generally go up, the risk-free rate goes up. Arbitrageurs will then naturally demand a higher return above that higher baseline to make the merger risk worthwhile. So rising interest rates can actually pressure spreads to widen.
Interesting. So higher rates mean arbitrageurs want a bigger spread.
Generally, yes, to maintain the premium over the risk-free alternative. Conversely, when rates fall, that baseline drops, which could allow spreads to narrow a bit, although the deal risk and time elements are usually the stronger drivers of the actual spread size.
So you're always weighing the deal's potential profit against just sticking the money in something safe like T-bills. The spread has to be good enough to justify the risk and the lockup period.
That's exactly right. It's a dynamic calculation. Deal risk, time, interest rates, they all feed into the size of that spread you see in the market.
Okay, so we understand why the spread exists. How do you actually calculate it? Put some numbers on this potential profit.
Well, like we touched on, it really depends on how the deal is structured. Cash deals are the simplest.
Right, offer is $50 cash, stock's trading at $48, the spread is $2. Pretty straightforward.
Exactly. $2 or about 4% potential return if it closes. The real math starts getting more involved with the stock for stock or the mixed cash and stock deals.
Because the value you receive isn't fixed.
Right. Especially if there are dividends involved, either from the target company while you're holding it or from the acquirer, which affects the value you get. It gets complex quickly. You've got the exchange ratio, the acquirer's stock price fluctuating, maybe even costs if you're shorting the acquirer's stock as a hedge.
This sounds like where you need a spreadsheet. Our sources use that Pfizer-Wyeth deal from 2009 as a good example of a mixed deal. Let's walk through that.
Yeah, that's a great illustration. So Pfizer, ticker PFE, announced it was buying Wyeth, WYE, back in January 2009.
Okay.
The terms were specific. For each share of Wyeth, shareholders would get $33 in cash plus 0.985 shares of Pfizer stock.
Okay, part cash, part stock, mixed deal.
Yep. Now, the source gives us prices from a specific date after the announcement, February 27, 2009. On that day, Wyeth stock, WYE, was trading at $40.82, and Pfizer stock, PFE, was trading at $12.31.
Okay, got the inputs.
So to figure out the value of what a Wyeth shareholder expected to receive if the deal closed right then, you do the math. You take the $33 like cash, and you add the value of the Pfizer stock portion. That's 0.985 Pfizer shares multiplied by Pfizer's price of $12.31 per share.
So 0.985 times $12.31. Carry the one.
It comes out to about $12.12 worth of Pfizer stock.
Okay, so $33 cash plus $12.12 in stock value.
Right. That totals $45.12. So on February 27th, 2009, the theoretical value you'd get per Wyeth share if the deal closed successfully, and PFE stayed at $12.31, was $45.82.
But Wyeth was only trading at $40.82.
Exactly. That difference is the spread, the potential profit. $45.12 minus $40.82 equals $4.30 per share.
Okay, $4.30 potential gain on a $40.82 investment. What's that as a percentage?
It's about 10.5%, $4.30.82. Wait, the source says 9.5% discount. Let me recheck the calculation. The source seems to calculate the discount as spread deal value, $4, $35, and $12,012 and 12%, not spread market price. Let's stick with their 9.5% figure as the potential return relative to the value received. So a 9.5% potential gain.
Okay, 9.5%. That sounds decent, but you said time matters hugely.
Critically, a 9.5% return is great, but is it over a month or a year? The source estimated this way the deal might take about 7 months to close from that February date. That's roughly 0.58 years.
So how do we annualize that 9.5%?
Well, if you take that 9.5% return and you earn it over 0.58 years, the source calculates the annualized return at 20.58%. That's a hefty annualized rate.
Wow, okay. So the shorter timeline really juices the yearly return number. What if it took longer, say 10 months?
If it dragged out to 10 months, which is about 0.83 years, that same 9.5% actual return would annualize to only about 11.45%, 9.5%, 0.83, much lower. It really shows how delays impact the attractiveness.
Definitely. Every month counts.
And the pros take it even further. They don't just look at the potential return if it succeeds. They try to estimate the probability of success versus failure.
Factoring in the risk it might blow up.
Exactly. To get an expected return. This is usually more realistic. You estimate your gain if it works, your loss if it fails, and weight them by your estimated probabilities.
How does that work?
For the Wyeth deal, the source example assumes a potential gain of $4.90 per share on success. That includes the $4.30 spread plus maybe the 60 cents in Wyeth dividends you'd collect while waiting.
Okay.
And they estimate a potential loss of $2 per share if the deal collapses and Wyeth stock price falls back. Then they assign probabilities, let's say, a 70% chance of success and a 30% chance of failure.
So you weight the outcomes.
Yep.
Expected gain on success, probability of success, minus loss on failure, probability of failure. So $4.97.
See,
$2.30.
okay, that's $3.43 minus your 60 cents.
Which gives you a net expected gain of $2.83 per share, much lower than the potential $4.90 if everything goes right.
Right. It averages out the possibility. So you expect to make $2.83 on average from this type of situation, given those probabilities.
That's the idea. And then you annualize that expected dollar gain. The source shows that $2.83 expected gain over the 0.58 years on the $40.82 investment annualizes to an expected return of 11.95%.
Okay, 11.95%. That's way lower than the 20.58% potential annualized return, but it feels more grounded because it accounts for the risk of failure.
It's a much more sober assessment. It shows that even with a nice-looking spread, the underlying risk analysis is paramount. And of course, you'd need to factor in dividends precisely, any financing costs. Remember, Pfizer had to borrow billions and keep refining your time estimate. It's all part of the calculation. Right, so that calculation hinges on the deal closing. But we keep saying the spread exists because maybe it won't. What are the big reasons a deal might just die?
Yeah, this is the flip side. The real risk arbitrageurs are paid to take. Deal failure is the main way you lose money here. Our sources lay out the main culprits.
Top of the list.
Regulatory hurdles, almost always number one, especially for big deals. Antitrust is the big one in the U.S. That means the FTC and the DOJ looking hard at whether the deal harms competition.
And they can just say no.
They can try to block it in court or demand the companies sell off parts of their business divestitures as a condition for approval. And it's not just antitrust. Specific industries have their own regulators, banks have the OCC, airlines the DOT, media the FCC. They all get a say.
And if the companies operate internationally,
oh boy.
Oh yeah, then it gets really complicated. Think about Microsoft buying Activision Blizzard, needed approval from regulators in dozens of countries. Each one has its own process, its own concerns. A rejection in one key market could potentially torpedo the entire deal. It adds massive complexity and delay risk. Okay, regulatory nightmare. What else?
Financing conditions. A lot of these deals involve debt. The acquirer needs to borrow potentially huge sums of money. Remember, Pfizer needed over $20 billion for Wyeth.
Right.
If the credit market suddenly frees up, or interest rates spike, or the acquirer's own financial situation gets worse before closing, that committed financing could disappear or become way too expensive.
So a downturn in the economy could kill a deal that looked solid before.
It absolutely could. Then there's the shareholder vote. Even if management agrees, the shareholders usually have to approve it, both the target shareholders and sometimes the acquirer's shareholders too. They could just vote no. Maybe they think the price isn't good enough, or they don't like the deal for strategic reasons.
My owners get the final say.
They do. You also have material adverse change clauses, usually called MAS clauses, baked into the merger agreement. These basically define really bad things that could happen between signing and closing that would let one side walk away legally.
Like if the target company's business suddenly collapses.
Exactly. Or a huge lawsuit emerges, or some other disaster strikes that fundamentally changes the deal's value. These clauses are tricky and often end up in court if someone tries to use one.
More uncertainty.
Yeah.
Anything else?
Sure. There's always the risk of pending litigation, maybe shareholders suing over the deal price or process. And if it started as a hostile takeover where the target company didn't want to be bought, their defenses could still scuttle the deal later on.
Wow. That's quite a list of things that can go wrong. No wonder there's a discount.
Absolutely justifies the spread. And like we said, the size of the spread is often telling you what the market thinks about the odds of hitting one of these landmines. A really wide spread usually means the market sees big regulatory risk or maybe financing worries. The sources mention some current large deals, Albertsons, Ansys, Capri, Kellanova, trading at wide spreads precisely because of that regulatory uncertainty.
So a wide spread isn't just potential profit. It's a potential warning sign. If the deal does fail, what happens to the arbitrager?
Well, that's usually painful. The main reason the target stock was trading high, the prospect of the buyout evaporates. So the stock price typically tanks, often falling right back to where it was before the deal was even announced, sometimes even lower if the failed deal reveals problems.
Ouch. So you bought high, expecting higher, and instead, it crashes.
That's the risk you take. You lose the difference. It underscores why assessing that probability of failure is so critical.
Okay, so these deals and their spreads don't exist in isolation, right? There's a whole M&A market out there. What drives the overall activity?
That's right. The broader context matters a lot. Several big forces shape the M&A landscape. Economic conditions are huge. Low interest rates make borrowing cheaper, so companies are more willing to finance big acquisitions with debt.
And when the economy's strong
GDP growth, high corporate profits that builds confidence. Companies feel better about making big strategic bets. On the flip side, recessions or rising rates tend to cool things off. Industry trends are also massive drivers. You see waves of consolidation. Sometimes companies merge for scale when an industry is hot. Other times, strong players buy up weaker ones when things are tough. Acquiring specific capabilities is big now, too. Buying AI firms, cloud companies, fintech innovators.
Right, buying growth or tech instead of building it.
Exactly. Or consolidating in fragmented sectors, like we're seeing with regional banks. And simple competitive dynamics played a role, buying a rival to gain market share or eliminate a threat.
How does the regulatory climate fit into this big picture? You mentioned it affects individual deals.
It has a huge impact on the overall market, too. Our sources noted that U.S. regulators, the FTC and DOJ particularly, have been taking a tougher stance lately, often described as more hostile towards mergers.
What does hostile mean in practice?
Yeah.
More scrutiny.
Yeah, more scrutiny, longer reviews, asking for way more information, and just being more willing to challenge deals in court, especially the really big ones. This creates uncertainty for companies thinking about M&A.
So it might make companies hesitant to even propose big deals.
They can, yes, or push them towards smaller, less risky deals. And for arbitragers, this tougher environment is a key reason why some deals get bogged down in regulatory review and trade at those wider spreads. The market factors in that heightened risk.
So the regulator's attitude directly shapes the opportunities and risks in merger arb.
Absolutely. It's a major factor. And the sources bring up the U.S. election as a potential catalyst here.
How so?
Well, regardless of who wins, leadership changes are likely at the FTC and DOJ afterwards. A new team might bring a different philosophy, maybe one that's perceived as less hostile to M&A. It's not certain, but if the regulatory environment seems likely to become less challenging,
that could boost M&A confidence and maybe help resolve some of those suck deals with wide spreads.
That's the idea presented. It's an interesting intersection of politics and market dynamics that arbitragers are certainly watching. Again, we're just reporting what the sources say about potential impacts here.
Understood. What about the current state of play? The sources had some recent data from September 2024.
Yeah, some interesting points there. Globally, M&A value was actually up in the first part of 2024 compared to the year before, even though the number of deals was slightly down.
So fewer deals, but bigger ones. Mega deals.
Seems like it. Especially deals over $10 billion saw an uptick. It might signal that confidence for those really large strategic moves is returning. And the U.S. is still the dominant player, making up almost half of global M&A value. That's a 5-year high.
Which sectors are hot?
The big ones mentioned align with those trends we discussed. Tech, driven by AI and digital transformation, no surprise there. Energy and power, think energy transition, security, and financials' ongoing consolidation, especially regional banks. Another really big trend highlighted is private equity. PE firms were involved in almost a quarter of all M&A value through buyouts.
Why are PE firms so active?
The sources point to a few reasons. They like taking companies private to avoid the costs and scrutiny of being public. They typically have a longer investment horizon than public markets demand. And importantly, they're sitting on a lot of dry powder capital they've raised that they need to invest.
So they're putting that cash to work, buying companies.
Yeah.
Makes sense. Anything else notable?
Yes, the SPAC market seems to be making a comeback in terms of arbitrage potential.
SPACs. The blank check companies.
Right. After a quieter period, new SPACs are launching, and competition among them has apparently led to wider SPAC arbitrage yields. The sources suggest these yields look attractive compared to other short-term fixed income, especially since the returns can often be taxed as capital gains.
So that's another distinct arbitrage play within this event-driven world.
It is. Different mechanics, but a similar idea of capturing a spread based on a corporate event. Overall, the picture from late 2024 suggests a decent pipeline of potential deals, especially in North American small and mid caps, alongside those big, complex deals still navigating the regulatory maze and offering those wider spreads.
Okay, so we've dissected how it works, the risks, the market environment. Why would someone actually want to add this kind of strategy to their investment portfolio? What are the benefits?
The biggest one, really, that the sources emphasize is that it's an absolute return strategy. Remember, the goal is positive returns, whether the overall market is up, down, or sideways.
Because the profit comes from the deal closing, not from the market going up.
Exactly. It's driven by the specific event outcome. And this leads directly to the next major benefit. Low correlation.
Meaning its returns don't just follow the stock market.
Historically, they've shown very low correlation to traditional stocks and bonds. Its performance pattern is different. The sources give numbers correlation near zero with bonds, maybe around 0.16 with T-bills. One source mentioned a higher number for stocks, 0.83, but typically it's considered much lower, often in the 0.1 to 0.4 range relative to broad equities. The point is, it zigs when other things might zag.
And that's the key to diversification, isn't it? Mixing assets that don't move together can lower your overall portfolio risk.
Precisely. Adding something uncorrelated or lowly correlated can potentially smooth out your ride and improve your risk-adjusted returns. This ties into the idea of market neutrality, trying to avoid general market risk and drawdown minimization.
Meaning it doesn't fall as much when the market crashes.
Generally, yes. Because its returns depend on deal outcomes, not market sentiment, it tends to hold up much better in bear markets. The sources cited data showing event-driven strategies, which include merger arb, had an average quarterly loss of only about negative 1.56% in bear markets, compared to the S&P 500 losing almost 1.9% on average in those same periods.
Wow, that's a huge difference in downside protection.
It really highlights its potential as a defensive diversifier. It can act as a potential hedge for a traditional long-only stock and bond portfolio.
Okay, diversification, lower drawdowns. Any other perks?
Tax efficiency is often mentioned. The profits from merger arbitrage deals are usually treated as capital gains, not ordinary income. In many places, capital gains are taxed at lower rates, so you potentially keep more of what you earn after taxes.
That's definitely a plus for taxable accounts. What about the interest rate environment we talked about? How does that play into the benefits now?
Well, historically, rising rates could lead to wider spreads as arbitrageurs demanded more compensation over the higher risk-free rate. The current situation, as described in that September 2024 commentary, is interesting, even though rates might be expected to come down.
Which usually makes bonds look better.
Right, but the argument is that merger arb still looks attractive relative to fixed income. Why? Because spreads on many deals are already wide due to those regulatory risks we discussed. So you potentially have wide spreads plus the prospect of falling rates making traditional bonds less appealing.
So it's kind of a potential sweet spot. Rates might fall, hurting bond returns, but M&A spreads are being held wide by other factors.
That's the perspective offered in the commentary. You have ongoing M&A activity, wide spreads on certain deals due to non-rate factors, and potentially less competition from falling rate fixed income. It's presented as a potentially favorable setup.
It sounds like a strategy with real diversification benefits. But you said it's been around a long time. Graham, Buffett, Greenblatt. Has it changed much over the years? Is it still the same game?
Oh, it has definitely changed. The core idea is the same, but the playing field looks quite different now compared to, say, the 1990s. A key study from the CFA Institute looking at data from 1990 to 2007 found something really significant.
What was that?
A major decline in the average size of the arbitrage spread.
Really? How big a decline?
The study suggested spreads shrank by over 400 basis points, that's 4 percentage points after 2002, compared to the earlier period. Looking just at the spread right after a deal announcement, the median dropped from a range of 4% to 7% before 2001, down to just 1% to 2% afterwards.
Wow, from potentially 7% down to 1 or 2%. That's huge. Why did that happen?
The analysis points to a few related factors. First, reduced transaction costs. It just got cheaper and easier to trade. Lower commissions, tighter bid-ask spreads, less market impact from big trades thanks to technology and things like decimalization.
So it became easier for arbitrageurs to jump in and close the gap.
Exactly. Lower friction means the spread gets arbitraged away faster. The study noted that spreads measured very close to the deal completion date, which mostly reflect these costs, showed the biggest drop.
Okay, lower costs. What else?
Increased interest in capital flows. Simply put, the strategy got popular, more people recognized the diversification benefits, more hedge funds launched to do it, and tons more money flowed into those funds.
More money chasing the same deals.
Yep. So when a deal gets announced, you have way more buyers rushing in to grab the target stock. That intense buying pressure bids the price up much faster, narrowing the spread much farther than it used to. The data showed target stock trading volumes jumped significantly after 2001, supporting this idea.
More competition squeezes the profit potential. Makes sense.
And a third factor was a reduction in the average risk of mergers. This sounds a bit counterintuitive given what we said about regulatory risk, but it's about the mix of deals changing over that specific study period.
How so?
There was a trend towards more cash deals, which naturally have lower spreads than stock deals because the payout is fixed. Also, the average premium offered by acquirers dipped a bit. And maybe most importantly, there were fewer hostile takeovers. Hostile deals are way riskier and always carry much wider spreads.
So the average deal happening just became a bit less risky, contributing to tighter average spreads.
That seems to be part of the story, yes. So you combine lower trading costs, way more capital competing for deals, and a shift toward slightly less risky deal structures, on average, it all led to structurally tighter spreads compared to the earlier days.
What does that mean for investors today?
Well, the analysis linked this spread compression to the broader decline seen in overall hedge fund alpha or outperformance. And it suggests that some of that spread shrinkage might be permanent due to market efficiency gains. For anyone looking at merger arbitrage performance, the big takeaway is be cautious with very long-term historical data. The market dynamics and typical spreads since the early 2000s are likely much more relevant than what was achievable back in the 90s.
That's crucial context. The game has changed. Given all this complexity, calculating spreads, assessing risk, maybe using hedges, was this ever something a regular individual investor could realistically do?
Historically, not really, no. For decades, merger arbitrage was pretty much exclusively the playground of big institutions, pensions, endowments, big funds, and the very wealthy.
Why only them?
Because accessing it usually meant investing in specialized hedge funds, and those funds typically had, multi-million-dollar minimum investments and were only open to accredited investors who met high income or net worth requirements. Plus, trying to do it yourself directly requires a lot of capital to diversify across many deals, deep analytical resources, and constant monitoring. It wasn't really feasible for most individuals.
So you needed deep pockets and special access?
Pretty much. But that picture started to change more recently. Our sources mention regulatory shifts around 2019 that really opened things up.
What happened?
Essentially, rules changed that made it easier to offer strategies like merger arbitrage within more accessible fund structures, specifically liquid alternative mutual funds.
Liquid alts. So mutual funds that everyday investors can buy.
Exactly. Unlike hedge funds, these mutual funds have much lower investment minimums. They're available to basically any investor, and they trade daily like regular mutual funds. They pool investors' money and have professional managers run the merger arbitrage strategy inside the fund.
So you're not picking the deals yourself. You're buying into a fund managed by pros who do it for you.
Precisely. These liquid alt funds became the main way for individual investors, like you listening, to potentially get exposure to merger arbitrage and its characteristics, that low correlation, the absolute return focus without needing institutional level wealth or access. It really democratized the strategy to a large extent.
That's a pretty big deal. Opens up a whole new potential tool for portfolio building.
It certainly broadened the options available for investors seeking diversification beyond traditional stocks and bonds.
This has been fascinating, a real look under the hood. Let's try and wrap up the key takeaways.
Sounds good. So at its core, merger arbitrage is about trying to profit from that price difference, the spread between a target company's stock price and the announced takeover price.
And that spread is there because deals aren't guaranteed, there's risk of failure, delays, plus the time value of money.
Right. Calculating the potential profit involves understanding the deal terms, cash, stock, or mixed factoring in things like dividends, and crucially, estimating the time to close to figure out the annualized return, and always weighing that potential return against the probability and cost of failure.
The risks are real regulatory blocks. Financing falling through, shareholders voting no. If a deal dies, the arbitrager likely takes a loss.
Definitely. And the whole M&A market is shaped by the economy, industry shifts, competition, and very importantly, the attitude of regulators, which directly impacts deal flow and spreads. We're seeing trends like more mega deals, lots of PE activity, and maybe a comeback for SPAC ARB.
But despite the risks and complexities, the potential benefits are clear. It's an absolute return strategy aiming for profit in any market. It offers low correlation to stocks and bonds for diversification.
Potentially lower volatility and smaller drawdowns, especially in bad markets, plus possible tax advantages.
And while the game has changed over decades, with spreads generally tighter now due to market efficiency and more capital,
The strategy itself is much more accessible than it used to be for individual investors, mainly through liquid alternative mutual funds.
it's a strategy that really forces you to sweat the details, doesn't it? Forget the market noise. Focus on this deal, this spread, these risks.
Absolutely. It requires real homework, digging into the specifics of the transaction, understanding of potential roadblocks, and doing the math on the risk versus reward.
So as you think about diversifying your own investments, considering strategies like merger arbitrage means looking beyond just market direction. It means analyzing specific events, but it's not simple. It demands that careful analysis of the fine print, the risks, the numbers. So here's something to think about. If you were considering this, what specific homework, what kind of detailed digging would you personally do before putting money into a potential arbitrage situation?